Hi, welcome back to Westbury 101. I'm Brian Westbury, Chief Economist at First Trust Portfolios. Remember, we want to be the antidote to conventional wisdom. Well, last Thursday, February 5th, there was a leak, a rumor that mark-to-market accounting might make it in to the new bailout package that would be announced by Timothy Geithner, the new Treasury Secretary, early this week. Today it's Wednesday, February 11th. And if you recall, Thursday and Friday of last week, the market had a booming rally. The S&P was up 5% from the time the rumor came out on Thursday afternoon by the close on Friday. The banking sector in the S&P 500 was up almost 20% in that period. Well, the market gave all of this up on Tuesday when the new Treasury Secretary finally came out with his bailout plan, and no mention of mark-to-market accounting was made. Now, it turns out that after the hearing, talking to reporters, Christopher Dodd, who also was the source of the rumor last Thursday, once again said that mark-to-market may be in the final bailout package, may be being a kind of a not very clear set of words. And I guess my attitude on this, and apparently the market's attitude on this, is that you fool me once, shame on me. You fool me twice, maybe shame on you, because the stock market got hammered as Timothy Geithner was talking yesterday, talking about this bailout package, but not including mark-to-market accounting in it. We were down almost 5% on the day. And I would right now say that the odds have shifted against it. And I want to talk just briefly about mark-to-market accounting and kind of the different sides of the picture, what those who are against any reform are kind of saying. And I've kind of boiled this down. It's not just about accounting rules, but in fact your view of the world. In fact, many of the people who support mark-to-market accounting don't believe it's a problem today, argue that it should be left in place, also believe, or in fact fundamentally believe, that the value of assets, the value of mortgages, the value of credit card loans, the value of auto loans, whatever you're looking at in society, truly is where the market is pricing them today. That in fact it has nothing to do with illiquidity in these markets. It has nothing to do with any feedback effects. That in fact we just lent too much, everyone was too crazy, and the value of these assets deserves to be at this level. Even if today we haven't seen massive defaults, we have seen many defaults, but the kind of defaults that are priced into the market, we eventually will see those defaults. And therefore these prices for these securities are correct. And therefore they don't see how any change in mark-to-market accounting would help us at all. Now, my one point to these people is that they are, in a sense, if they believe that, are marking to a model. They're marking to their model that the economy is going to fall apart and that these prices will prove to be correct in the future. The second thing I think that they are missing is the fact that mark-to-market accounting, because it forces companies to write prices down to what may happen in the future in the worst of all worlds, that in fact that provides a feedback mechanism that hurts the economy today. So think about this. In the good times, mark-to-market accounting allows financial institutions to write up their assets. That makes them feel better. They have more capital on their books, and therefore they lend even more. They believe the risk environment is even less than it really is, and the whole system expands. And then when the system turns around and goes the other way and they're forced to mark assets down, then their capital is being eroded. They pull back. They lend less. Private investors are less willing to invest in the system. So in fact, mark-to-market accounting is creating some of the negativity and some of the negative effects that we're seeing in the economy. There is a negative feedback loop going on, and my belief is that mark-to-market accounting is not only making the economy worse, but in fact is almost a self-fulfilling prophecy that if we leave it in place, we will continue to see the economy contract because capital is contracting. The only way to fix our banking problems today is either to remove all the toxic assets from bank balance sheets or insure them or create some kind of public-private partnership that gets all of those assets off and keeps the write-downs from hurting banks even more, or changing mark-to-market so that the declines in those assets can be absorbed over time rather than being forced on financial institutions right away. Now, let me come back to this idea of will we see a change in mark-to-market accounting or not. Barney Frank, in an interview on CNBC this morning, said that he doesn't think mark-to-market might change, but we might change the capital rules, and I'm paraphrasing, surrounding mark-to-market accounting. If you think about it, when you mark up assets, that gives you more capital, you feel better about the environment, you're willing to make more loans, and so what some academics believe is that in a rising asset value environment, we ought to raise capital ratios on banks so that they won't be able to lever up the rising asset values. At the same time, when asset values falls and it erodes capital, that we ought to lower capital requirements. So there is a way around mark-to-market without changing mark-to-market, just allowing banks to hold less capital officially today and make them hold more capital in good times and less capital in bad times, and that will offset some of the cyclicality, the pro-cyclicality of mark-to-market accounting. Let me come back also to one other point, and that is that the entire bailout package that we are talking about today to deal with these bad assets is literally because we are seeing these asset values as they decline affect the capital environment in our economy. To me, it is so clear that another way to get around this whole issue is to change mark-to-market accounting temporarily for certain assets, let's say issued between 2003 and 2007, these so-called toxic assets. Let's change it just so we can get through this time. After all, in the 1970s and early 1980s, our banks in the United States made tremendous numbers of loans that got them into trouble. Latin American debt, when they were recycling petrodollars, we were paying $40 a barrel to OPEC for oil. OPEC was depositing those dollars back into U.S. banks. U.S. banks were in turn lending that to Latin America. When Paul Volcker came in and jacked up rates, commodity prices fell. That killed Latin America, and all those debts went bad. Sounds pretty familiar, doesn't it? Because commodity prices have fallen now, and Latin America is in trouble too. At the same time, oil loans went bad. As oil fell in the early 1980s, when Paul Volcker tightened, oil loans that we had made billions of in the late 1970s went bad. And also in the 1980s and 1990s, the S&Ls got into serious trouble because they had written 30-year mortgages at 5 or 6%, but all of a sudden short-term interest rates were at 14, 15, 16, 17%, and they were paying 15% to depositors as interest, but they were only getting 5% on their investments, the mortgages that they had outstanding. No wonder 3,000 banks failed in the 80s up through the mid-1990s. But we did not have mark-to-market accounting then. In fact, what we did is we allowed those loans to work themselves out or not work themselves out over time. A bad loan is still a bad loan. Once it moves into default, a bank should have to recognize it. But a pool of mortgages should not be forced to recognize all kinds of losses that may or may not be true. And so when you go back and look in the 1980s and 1990s, we allowed banks time to work through these issues. At the same time, we had cut tax rates, which boosted growth. And when you have more growth and more jobs, asset values don't decline as much. Today, we seem to be doing the opposite. We're not allowing banks any time. We're interfering in the economy with stimulus and capital purchase programs and all kinds of things which are lowering the growth potential of the U.S., which is making our problems worse today. So I still believe that there is something to the rumors that Chris Dodd is talking about and some willingness in Barney Frank to address these issues. And I still believe the odds are slightly in favor of some changes in mark-to-market accounting. However, just like every other government policy, it's like making sausage, and you never want to see that sausage made, and the volatility in the markets are going to be tremendous. But I think when this process unfolds over the next couple of weeks, I still believe we will see some relief from mark-to-market accounting. So stay tuned. We'll tell you more as we get the information. But thanks for coming to Westbury 101. Remember, we want to be the antidote to conventional wisdom.